Well, good morning, everyone. I'm Allison Slater from the Global Risk Institute, and I'm delighted to welcome you to today's webinar, Climate Change, Layering Further Complexity on Mortgage Risk. And although this event is virtual and many of you are joining us from across Canada and beyond, I'd like to acknowledge that the Global Risk Institute is headquartered in Toronto, which is situated on the territory of many nations, is covered by Treaty 13 with the Mississaugas of the Credit, and is now home to many diverse First Nations, Inuit, and Métis people. Through this land acknowledgement, we want to bring context to the history of our country and the importance of working towards reconciliation in all the ways that we can. Before we begin today's session, I'd like to review a few housekeeping details. Note that your microphones are muted to avoid background noise, but we have allocated ample time for questions, which we'll take through the chat function, which is at the bottom right-hand corner of your screen. I'll be monitoring those. Make sure that you send them to all panelists. We'll bring as many of these questions into the discussion as we can. And finally, your feedback is valuable to us. Before we end today, a short Slido survey will appear on the right-hand side of the screen. We'll appreciate your considerations for future programming. And now I'd like to briefly introduce our speakers for today's session. You can find their full biographies on our website. Nez Aquino is the Chief Risk Officer at Vancity, where she oversees the comprehensive array of risks the institution faces today. She has held progressive roles at Vancity over the last 14 years. She's a CPA and had a stint at Bank of America before arriving at Vancity. She's a board director at Pacific Blue Cross and the Vancouver Symphony Orchestra. Welcome, Nez. We have also Steve Menell with us, who's the Chief Climate Officer at CMHC, where he leads initiatives to mitigate and adapt to climate change in Canada's housing and housing finance systems. Steve has held many positions at CMHC over his years there, including Chief Risk Officer and Senior Vice President of Mortgage Insurance. And finally, Catherine Bakos. She is Director, Climate Finance and Science at the Intact Center on Climate Adaptation at the University of Waterloo. Her research focuses on assessing the impact of climate change on industry and the capital markets. Catherine is a director of the Oak Ridges Moraine Land Trust and a member of the Ontario Biodiversity Council and Canadian Association of Farm Advisors. So we've got a great and interesting panel assembled for you today to take on this very challenging question. Catherine, would you set the stage for us by sharing the findings of your recent study on the impact of flooding on the residential housing market? Over to you.
Thank you, Allison. And yes, of course, I'd be happy to. And hello, everyone. I'm happy to be with you all today. I have a few slides to go through to really set the groundwork for our subsequent discussion with Nez and Steve, and really to help paint the picture of when things go wrong as depicted in the photos that you see here. What do these types of flood events mean for the Canadian residential real estate market? So I believe we all have a general perception that there are negative impacts. But to what extent does flooding impact variables such as the sold price of houses, number of houses listed for sale, days on market to sell a house, and mortgage arrears and deferrals? To answer these questions, our team at the Intact Center engaged a study which used real data. This is not a scenario analysis, and it's a true representation of what actually happened in the Canadian market to investigate the impact flooding has on those particular variables over a 10-year period. And this is what we found. Next slide, please. So the report that you see here, Treading Water, Impact of Catastrophic Flooding on Canada's Housing Market, we found that for a period of 6 months before versus 6 months after a catastrophic or a major flood event over a 10-year period, and using a control situation to isolate for the effects of flooding, cities across Canada from the west to east coast saw most notably an average 8.2% reduction in sold price of houses listed on the market. Now, the sold price of homes within flooded communities ranged from negative 1.1% in Grand Forks, British Columbia, to negative 17.1% in Gatineau, Quebec, with all other cities falling in between that range and with the average being the 8.2% reduction in sold price. We also found that in flooded communities, 44.3% less homes were listed on the market for up to 6 months post-flood event. And this is perhaps due to an expectation of lower listing price in the aftermath of flooding, waiting for the stigma of flooding to pass, and or time required to remediate a house following flood damage prior to listing. When houses were listed on the market, they stayed there 19.8% longer, which may not be material as the median time to sell a house in Canada is 65 days, which translates into an additional 13 days on the market. but flooding still created a delay in the sale of homes. The big ticket item from our perspective was the average 8.2% reduction in sold price, which we refer to as a flood discount, and not in a positive sense. If you sold a house that would otherwise sell for $1 million, with the average flood discount of 8.2% in the aftermath of flooding, that house would actually be worth $920,000 instead. Now, this part of the research project pertained to cities that only experienced 1 to 2 catastrophic major flood events over a 10-year period. In another analysis throughout the report, a case study that we performed examined a major flood event that occurred in 2019 in Fredericton, New Brunswick. We determined that there was no impact of flooding on housing price in Fredericton. The reason being that between the period of 2008 to 2018, Fredericton had experienced a major flood event every single year except for 2016. What the case study determined was that under conditions where flooding is often and predictable, the impacts of flooding are permanently factored into the real estate market. Now, to clarify, it's predictable in the sense that we know the flooding will most likely occur, where and how it will manifest is not so predictable. So over the 2008 and 2018 period, flooding varied in impact due to varying combinations of heavy precipitation, ice jams, snowmelt, impacting different regions across Fredericton. Now, we're not picking on Fredericton here, but it was a great case study to show that when flooding occurs on a regular basis, but in unpredictable locations, the impact of flooding is permanently factored in to the entire housing market of that area. So regarding mortgage arrears and deferrals, we saw no consistent impact and findings tended to fall within market norms. Next slide, please. To offer a little bit more information, when evaluating the net impacts of 1 to 2 catastrophic flood events over a 10-year period pertaining to 2 major Canadian cities, the trend of residential mortgage arrears and deferrals was not consistent. So in other words, in one city, the flooded community experienced higher arrears and deferrals compared to the non-flood control community, which was in line with our hypothesis. While in the other city, the non-flood control community experienced a higher rate of arrears and deferrals. So another factor, or multiple factors, unrelated to flooding are impacting arrears and deferrals in these cities. Now, that's not to say that under different circumstances, whereby flooding might occur on a regular basis, which was beyond the scope of the mortgage portion of our study, that there may or may not be impact. In my opinion, further research for at least 20 cities across Canada needs to be investigated to explore if flooding or any other extreme weather event impacts mortgage markets. Now, if anyone's asking why we didn't do the analysis ourselves on 20 cities and only use 2 cities to begin with, well, to put it into perspective, and I would be happy to go into further detail after this webinar, but or during the discussion period, but this information was enormously difficult to obtain, and it took over 9 months to even get the data for the 2 cities. And that it did not include analyzing the data on a per 1,000 home basis. Now, from our findings alone for 2 Canadian cities, it would seem that the rigor that goes into stress testing to determine who gets a mortgage or not in Canada is sufficient to get people through one major flood. Whether or not that would be the case for a series of flood was beyond the scope of the study. What impacts did arise was in the reduction in the appraised value of a house due to flooding, which would influence limits on lending by mortgage providers. Mortgage approvals and rates depend in part, as I'm sure you all know, on the loan to value ratio of an insured property. If the value of a mortgaged property is compromised by unanticipated flood risk, lenders and insurers may erroneously approve or misprice mortgage rates, since the 8.2% reduction in sold price of homes is not accounted for in flooded communities. So if a homeowner relies on a mortgage to cover 80% of the purchase price of a house, and now you find the house is worth less, now it's a security issue for the bank or the mortgage provider. Next and final slide, please. So we've seen the bad stuff. We know flooding is bad for the residential housing market. The question is, what do we do about it? What are the solutions to limit flood risk for homes and communities? Well, the report offers a list of solutions, and I've provided a few here. Number 1, Canada needs to launch a national home flood protection education program to give homeowners direction on how to better protect themselves from basement flooding. Number 2, We need to incorporate flood risk into home appraisals, which can be done through working with the Appraisal Institute of Canada. Number 3, Canada needs to execute on its climate adaptation home rating program to incorporate energy efficiency and flood risk protection in one-stop shopping. Number 4, Canada needs to bring its flood risk maps up to date. On average, most maps throughout Canada are 20 to 25 years out of date. We need to make these maps publicly available as soon as possible to give communities a clear idea of where we should deploy efforts, disproportionately so, to protect against flooding. And finally, Canada needs individual flood risk scores. When someone goes to purchase a house, in the same way that you can see a walking score, they should be able to see a flood risk score in just the same manner. Thank you all so much. And Allison, I'm going to flip it back over to you. Thank you.
Catherine, thank you very much for kicking us off with this great piece of research. I think it really sets the stage, and I probably knows it reflects a lot of what you're facing at Van City. You're trying to cope with this at the institution level. We are all aware of the extreme climatic issues and that residents of BC have faced recently: floods, fires, extreme heat, some of the worst across Canada. Can you give us some insight into how Van City is assessing these extreme events and how it may impact its mortgage business going forward? What's your strategy with the realities of climate change really bearing down on us already?
Yes, for sure. And that was a great introduction, Catherine. And that's exactly what's on our minds for the last little while. Catherine gave a very good overview of the flood risks across Canada, but I'd like to turn our attention to British Columbia for a couple of minutes, which is where I live and Van City mostly operates from. So I'll start with a bit of an external context. There's a UK-based study that was published last year that ranked the 15 most impactful climate events that happened in 2021 in terms of the damage and harm caused. And 2 of those worldwide events were originating from British Columbia. The first one was the summer of 2021. Those of you who live in British Columbia, you'll remember the Lytton fires and the extreme heat wave, where on one day the temperature in Lytton registered 49.6 degrees, which is unheard of, followed by wildfires, followed by smoky skies. We couldn't see the sun actually for a number of months. And that wasn't the first time. It actually had started in 2019. So it's a recurring event. The second event was the flood events that we are all familiar with that happened in October between the Merritt and Abbotsford line, which caused human life, put the sustainability of farming at risk going forward, and certainly caused a lot of damage to hundreds of homes. And so, to use the lexicon of the insurance industry for a second, these events that used to be measured in once every 100 years, once every 200 years, are now pretty much once a year, maybe twice a year kind of events, at least where I live. And so, of course, we're thinking about the implications of all that on our business. Many of you may know this, but a majority of what we do at Van City is based on real estate-based lending. And that is true for a lot of Canadian financial institutions, right? It's not just Van City. So we have been partnering with the insurance industry over the last year. Some Canadian well-known names and some international global reinsurers who are helping us develop a model that takes what Catherine just explained very well, which is there is a risk to the security here on the mortgage at the individual address level, where we land, exactly where the property is, what is our security, against this mortgage that we land, all the way to the loss given default, the loan to value ratio, and what's going to happen with the probability of events. That can help us understand the kind of reserves we need to build up in our expected credit losses, ECL, as is known in the industry. It's another way of saying we just need to increase the capital deployment to certain locations. So we haven't quite done this. We haven't finished the work yet. We're just in the thick of it. But I am certain, based on what we're seeing right now, that we, among many financial institutions, certainly have exposure to flood and fire risk, and it will certainly require us to think differently going forward about the rate, the kind of capital reserve we need to think about, and really whether there is going to be really a shift in the kind of location that we land to, where we land, and how we land. And I should also add that the kind of tool we're partnering about with the insurance industry is scenario driven, and they're, I'm not going to say widely accepted, but generally accepted scenarios now in the climate world. They're the representative climate pathway scenarios, RCPs, that are endorsed by IPCC. I know there are many acronyms here, but Intergovernmental Panel on Climate Change, endorsed by United Nations. And so, somewhat standardized scenarios that tell us, depending on the temperature rise over the next 50 to 100 years, what is our specific exposure in the locations where our security is addressed. So that's the work we're looking at right now. And it's absolutely necessary work, and it will just evolve from here on. And I'm really looking forward to connecting with other financial institutions and the insurance industry on how we can together evolve that work.
Thank you very much, Nez, for giving us just a snapshot of the depth of work that you are undertaking now. I can't believe you're getting down right to the address level. This is an incredibly important work, and I have a feeling that we'll have a million questions flooding in for you from the audience, because I think all banks and financial institutions involved in real estate are looking at this. But before we open the floodgates, I just want to pardon the pun, I just wanted to pass to Steve, because Steve, you're looking at more the system level in your role at CMHC. I just wanted to bring you in and sort of reflect a little bit. Catherine had some ideas about what needed to be done or what could be done to mitigate things. I guess, what are some of the main risks you're looking at that system level to the mortgage market that keep you up at night, and some of your priorities for action?
Thanks, Allison. So yeah, as you mentioned, we are looking closely at the system effects of all of these climate hazards. In fact, part of our formal mandate at CMHC is to promote the stability of the housing system and of the housing finance system. So this is actually built into our mandate and our legislation. So we take it quite seriously. I would say there are four main ways that physical climate risk affects the stability of our system. The first one is the obvious direct effects. When you have property destruction, there's a cost to that, and that has a destabilizing effect on the housing that's affected and on the households that live there. So that was pretty obvious, and we want to do everything that we can to avoid these things. And I would say that we are not doing a great job at the system level in avoiding climate-related risk, in particular flooding, as Catherine has highlighted. But in some of the other areas as well, I think there's quite a bit more that we could do to mitigate and avoid these risks, rather than allowing them to occur and to kind of spill over into the housing finance system. But then there are several indirect effects on stability that I'm going to kind of categorize in under three categories. The first one are the social and health related effects. We know that vulnerable populations, vulnerable communities, or people who are already vulnerable to within the housing market tend to be concentrated more in areas that are more vulnerable to climate-related risk. And so the effect of some of these events, flooding in particular, is more acute on vulnerable populations than on the general population. And this